Good morning. Welcome back to the broadcast, Retirement Network. I'm Jeff Snyder. This is BRN AM for Friday, October 1st, 2021. And our top story today, student loan developments, loan default rates, loan forgiveness, neg regs, and a lot more. Joining me now to discuss this and a lot more is Betsy Mayad of the Institute of Student Loan Advisors. Betsy, great to see you. Thanks so much for joining us on the program this morning.
Good to see you too.
All right, so we're going to dive in. There's a lot going on with student loans. Let's start with the default rate. How are we doing from a default rate perspective in this country?
So the federal student loan default rates came out yesterday, and I'm not trying to be a Debbie Downer because at first appearances they look great. The national default rate for the cohort that starts in 2018, and I'll explain what that means in a second, is 7.3, which is down from 9.7 for the 2017 cohort, which was released last year. So that sounds like that's a huge decrease. It sounds amazing. The reason I'm not super excited about that is because a big reason for that is because of COVID. The vast majority of federal student loan borrowers have had their loans on hold, so there have been no new defaults since March of 2020. So it's sort of a fake, I want to call it fake news, but it's sort of a fake decrease.
Well, I mean, it's not fake in the sense that it's reality, but it's caveat emptor, right? You got to recognize that the circumstances have dictated maybe help the lower rate.
I like the way you put it much better than the way I put it.
Wow.
So, it's the way the cohort default rate works is they measure the people that default within 3 years of when they first go into repayment. So I think I've said this to you before. The default rate is a little bit of it's not a true picture of student loan defaults. The actual student loan default rate overall is actually closer to 20% or more. But this cohort default rate that they publish and measure only looks at that first 3 years from the time that people first go into repayment.
Now, Bets, go ahead.
You go.
Oh, okay. I just have a question. Is there a difference between defaulting if you are using a private student loan or have a private student loan versus a federal student loan?
That's a really good question. There's a huge difference. So defaulting on a private student loan, you could technically be in default just by missing one payment. The process works very different. If you're delinquent by, say, 3 or 4 payments, then the lender on a private loan will put you into what's called a charge-off status, which doesn't mean you don't owe the loan. It reflects differently on how they book the loan from their accounting standpoint. But at that point, they could sue you for repayment. Now, with the federal student loan program, you're actually not legally considered in default until you've missed 9 payments. So you're over 270 days past due. And what happens then is that at that point, your loan is due in full. You're not eligible anymore for any lower payment options or deferments. They will start garnishing your wages. They'll take most federal payments, including your tax return, and they do all that without having to file a lawsuit. So they don't have to get a judgment to do all those collection tactics. And of course, they add up to 24% in collection costs, and it's a huge whammy on your credit.
I would think so, and I think that's something that people need to think about. So if I am in default or my child is in default, I don't have a child, but to say hypothetically that someone's in default, what do I do? What are my first steps? I call Betsy Mayad, I guess.
Well, you certainly could reach out to us for advice, but the federal student loan program has some pretty unique benefits to give people sort of a second chance. There's technically 3 ways out of default. You could pay the loan in full, which if you could afford to do that, you probably wouldn't have defaulted in the first place.
True.
You could consolidate the loan out of default, which is usually the fastest way of doing it. Takes about 45 to 60 days. Sometimes they ask you to make a good faith payment or 2 beforehand. And that will put your loan back in good standing and give you a fresh start. But the program that I like the best is called loan rehabilitation. And with that program, you make 9 consecutive on-time payments that are based on your income. And after the 9th payment, not only are you out of default, but they reduce the collection costs significantly. And best of all, they remove the default line from your credit report like it was never there in the first place.
And that's good. I want to talk about the financial impact in a second, but what about bankruptcy? I mean, we always hear about Chapter 11, Chapter 7 bankruptcy. Can you claim personal bankruptcy if this happens, and what are the implications of doing that?
So student loans are, so there's a myth out there that student loans are not dischargeable in bankruptcy at all, and that is what I said it was, which is a myth. It is incredibly difficult to get, especially federal student loans, discharged in bankruptcy. But you can file what's called an adversary proceeding to ask for the student loans to be brought in and considered for the bankruptcy. Most courts follow what's called the Brunner test, which has 3 prongs to it. You have to show that you made a good faith effort to pay, that if you were to pay, you would not be able to maintain a minimum standard of living, so feed and clothe yourself, and that things are unlikely to change financially in the foreseeable future. I've seen more and more borrowers be successful with that for private loans. It's very difficult to make that argument for federal because they have these income-based repayment plans.
Yeah. Betsy, last question before we go to break. And you mentioned, I'm not going to hit the credit score impact because you already talked about that. But let's go to student loan forgiveness. And just is there a quick update on that? I know we're going through this reconciliation process, and you and I have talked about student loan forgiveness for I guess since we met. So is there any development there?
Not at all, which is a development in and of itself.
Yeah, that's true.
I think when you and I have spoken about it, my take on it was that the President Biden does not at this point believe that he has the power under executive order to do broad student loan forgiveness, which has been his messaging from the beginning. But he's encouraged Congress to take that action. And I have said that whether or not Congress is going to do it, the real indicator will be to see if we see anything in any of the reconciliation bills. And there was not a whisper of it. In fact, there's very little student loan stuff in the higher education portion of reconciliation. So I think that's an indicator that Congress is just not interested in taking that up.
Well, at least not currently, but who knows down the line, especially as we enter into the fall, into the midterm election season. Betsy, I need to take a quick break. When we come back, we'll talk more about student loan developments and specifically the neg regs. What are they? You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you over 50? Would you like to get up to 33% more income in retirement? Then call now for this free book, Annuity Do's and Don'ts for Baby Boomers. This free book reveals little-known secrets about annuity strategies that will help you make the right choices before buying an annuity. Call right now for your free book, and as a bonus, we'll also throw in a free annuity rate report, both absolutely free for calling Annuity General today.
Call 800-504-8194.
Welcome back. We're talking to Betsy Matt of the Institute of Student Loan Advisors. Betsy, thanks for staying with us this morning.
No problem.
One thing before we get into what neg regs are, and I'm going to need an explanation because I have no idea what these things are. But let's talk about a service provider dropping out of the student loan service arena as of yesterday.
Yeah, so over the last couple of months, we've seen several large student loan servicers say, I'm out of the pool. And, you know, from an industry insider perspective, it's not a complete surprise. We knew the contracts were expiring, and we sort of heard that there maybe wasn't an interest in renewing them. So we saw Fed Loan Servicing and a servicer called Granite State announce a couple months ago. But what we saw this week was Navient, who's probably the most well-known and one of the larger student loan servicers, announced that they're actually looking to move their contract over to another company called Maximus. And the Department of Education has commented earlier this week that they have become part of those negotiations. So it looks like a done deal. So we're looking at about 8 million borrowers that are currently serviced by Navient moving over to Maximus at some point. Some are saying by the end of the year. I think it'll be by the end of next year for sure.
So that's administration, all the things that go around with servicing a student loan, getting updated amortization schedules, talking to them about payment, all that kind of stuff. So there's still, on top of what we discussed earlier this year, more developments there. I guess we'll be talking about that later this fall. Betsy, let's talk about neg regs. These are negotiated regulations, and can you just define this for me and for us?
Yeah, so neg reg is sort of the industry pet name for a process called negotiated rulemaking. Now, I personally, and I may be in the minority, I love neg reg because when negotiated rulemaking works as it's intended, to me, it's democracy at its best. But what it is the federal statute requires that anytime the Department of Education is going to make a substantial change to regulations, that they can't do it in a vacuum. They're required to bring representatives of all the potentially affected constituencies to the table and have them all work together to develop what these new regulations are going to look like. And if they come to agreement on those draft regulations, then the Department of Education is required by law to publish those draft regulations. So I love the idea, and this is the way this stuff should be written, that anybody who would possibly be affected by this change has a say in what that change is going to be. Now, I've been to every student loan related neg reg since probably 1999. I've been a negotiator 4 or 5 times, and I've seen neg reg go beautifully, exactly the way it should go. And I've seen it go south badly, especially the most recent one we had under the prior administration was not a good example of neg reg. But neg reg is when we see some pretty substantial changes happen to student loans.
Is Alice a key negotiator? Because I saw her just walk by. We love cats. I have 2, as you know. Just in terms of some of the topics, it looks like they're talking about accreditation, transfer of credit, and measuring student achievement at just some of these issues. Any others what's your reaction to some of these changes or potential changes?
This is what I would say potentially a very consumer-friendly agenda for neg reg. It's also a really heavy lift agenda. There's several different topics on this agenda that could be a neg reg in and of themselves, but they're looking at borrower defense discharge, which is the mechanism that borrowers would receive relief if they were defrauded by their schools. They're looking to make improvements to the income-driven repayment plans. They're looking to make some improvements to public service loan forgiveness, as well as total and permanent disability discharge. And another agenda item that I'm looking forward to talking about and hearing about is they're looking to see if they're suggesting a ban on pre-dispute arbitration clauses at schools. And I don't know if you want to explain to your listeners, or if you want me to explain to your listeners what a pre-dispute arbitration clause is, but
Yeah, I think you're going to have to do it because, quite frankly, I don't know. And as you were talking, I hear my cat, one of my cats, snoring, little Peaches snoring. But go ahead, do tell us what that means. And then I have one other question after. I do have one other question after that before we close out the show. Go ahead.
yeah, maybe our next episode, we should just have it between Peaches and Alice.
You hear Peaches go, "Meh." But do tell us what that means.
So one of back a few years ago when we had a bunch of scandals with especially for-profit schools all of a sudden shutting down, and it turned out they defrauded a lot of their students. What we also found is a lot of these schools in their enrollment contracts had what's called a pre-dispute arbitration clause, which basically forbade the students, it prohibited the students from being able to sue the school. Pre-dispute arbitration clauses happen in a lot of financial products, unfortunately, and it takes away the right of the consumer to sue the business. They're required to go through arbitration. Usually they have to do arbitration in the state of the business's choosing, which can be cost prohibitive to the general consumer. And the arbitration firm is one that's hired by the business. So they're not considered consumer-friendly clauses, and a lot of schools have them in their enrollment contracts. So during this NEGREG, we're going to be talking about whether the Department of Education has the authority to ban those in colleges and universities, and if they do, if they're going to ban them.
Yeah, really interesting. And as you said, very consumer-friendly focused. And I think given all the circumstances with COVID, everything that we've happened with this financial strife, really important measures that are at least being talked about. Last question for you, Betsy. We're facing a potential government shutdown. And so I guess I have to ask you, is there an impact to student loan servicing if the government should shut down?
In the past, there has not been a significant impact to students and student loan borrowers in a government shutdown. Most of the work that's done with student loans and with financial aid is actually done by contractors. And when there's a government shutdown, the contractors don't shut down. So the good news is that consumers should not see a significant impact by a government shutdown in this area. But of course, we feel for the Department of Education employees that aren't getting paid when such a shutdown happens.
That's true. That's true. Betsy, always great to see you. Thanks so much for the education. Really helped me learn more about these default rates, what it means, and what some of the potential changes could be regarding student loans. Great to see you. Thanks so much, and we look forward to having you back again very soon.
Take care.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more all in one place, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow for BRN Weekly. We'll have a very special guest, and we'll take a look at some of our best segments for the week. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.